Here's a moment that traps people every single session. Price pushes to a new high. The candle looks strong, green, decisive. Everyone watching price alone leans in and buys the breakout. But underneath that candle, the order flow is telling a completely different story. The delta, the balance of aggressive buying versus aggressive selling, is actually shrinking. New high in price, lower high in delta. That disagreement has a name. It is called delta divergence, and it is one of the earliest clues that a move is running out of fuel. In the next few minutes, we will break down exactly what delta divergence is, why it happens, how to read it on a footprint chart, and just as importantly, how not to get faked out by it. This is educational, not financial advice, but by the end you will see the tape a little differently. Let us make sure delta is crystal clear first, because divergence only makes sense once you understand the number it is built on. Every trade that prints happens at either the bid or the offer. When an aggressive buyer lifts the offer, that volume counts as positive. When an aggressive seller hits the bid, that volume counts as negative. Delta is simply those two totals netted against each other. Per bar delta tells you who was more aggressive inside that single candle. Cumulative delta strings those values together across the session, so you can see the running tug of war between buyers and sellers. A rising cumulative delta means aggressive buyers have been in control. A falling one means sellers have been leaning on it. Delta is not magic, and it is not a signal by itself. It is a measurement, a way to quantify intent that a normal candlestick throws away the moment it closes. So what is a divergence? A divergence is any time price and delta stop agreeing with each other. In a healthy uptrend, price makes higher highs and delta makes higher highs right alongside it. Aggressive buyers keep showing up, and price keeps rewarding them. That is confirmation. Divergence is the opposite. Price grinds to a new high, but cumulative delta prints a lower high than it did on the previous push. The market is still going up on the screen, but fewer aggressive buyers are doing the lifting. Somebody is absorbing them, or the aggression is simply drying up. The same thing happens in reverse at lows. Price makes a new low, but delta makes a higher low, which means sellers are pushing with less force than before. Divergence does not tell you the exact top or bottom. It tells you the fuel behind the current move is thinning. Here is the setup in its most common form. Imagine price rallies into an area, pulls back, then rallies again to a slightly higher high. On the chart it looks bullish, but when you check the footprint, that second push printed on much thinner buying. Per bar delta that was strongly positive on the first leg is now barely positive on the second, even though price went higher. That is buyers exhausting. They are still trying, but each attempt costs more effort for less ground. The people buying that new high are often the last and most emotional participants, the ones who waited for confirmation and got it at the worst possible moment. When the aggressive buying finally stops, there is nobody left to lift price, and it can roll over as those late longs get trapped and have to cover. Reading that exhaustion early is the entire point of watching delta. Now, an important distinction, because this is where people get it wrong. Weak delta at a high can mean two different things. The first is exhaustion, buyers simply running out of energy. The second is absorption, a large passive seller sitting on the offer and soaking up every market buy without letting price advance. In both cases, delta can look weak relative to price, but the mechanism is different. With absorption, you will often see heavy volume printing at one price level while price refuses to move up. Big effort, no result. That is a fingerprint of a resting institutional order. Whether it is exhaustion or absorption, the conclusion for a reader is similar. The up move is being challenged. But knowing which one you are looking at helps you judge how sharp the reaction might be and where your invalidation sits. This is the part most tutorials skip, and it is the most important. Delta divergence in the middle of nowhere is noise. Delta divergence at a meaningful level is information. Before a divergence means anything, you want price to be at a spot the market actually cares about. A prior high or low, a value area edge, an untested level, a session extreme. The divergence is the trigger. The level is the reason. When those two line up, a lower delta high right into a prior swing high, you have context and confirmation pointing the same direction. Without the level, you are just fading strength because a number looked small, and strong trends will run you over doing that. Always anchor the read to structure first, then let the order flow tell you whether that structure is being defended or overwhelmed. Let us talk about how divergence fakes people out, because it will. The biggest mistake is treating a single divergent bar as a sell button. One lower delta high in a powerful trend is often just a pause before continuation. Strong trends can diverge for a long time before they actually turn, and shorting every divergence is a fast way to get run over. A more patient read waits for confirmation that the divergence is being acted on. Price stalling at the level, a shift in who is now the aggressor, a break of the short-term structure that held the trend up. The divergence is your heads up to pay attention, not your entry. Think of it as the smoke, not the fire. It tells you where to look. Then you let price and flow confirm before you do anything. Sim this pattern first, count how often it actually resolves, and build your own read before risking a cent. Doing all of this by hand, tracking per bar delta, cumulative delta, comparing pushes, spotting absorption, is a lot to hold in your head while a fast market is moving. That is exactly the gap Imprint Flow is built to fill. It plots per bar and cumulative delta directly on your NinjaTrader 8 chart, marks the footprint imbalances and absorption, and lets you see divergence forming in real time instead of reconstructing it after the fact. The tool does not tell you to buy or sell, and it does not predict anything. It just makes the order flow visible so your read is faster and less emotional. You still make the decision. The software just removes the busywork and the guesswork about what the number actually was, so you can spend your attention on context and risk instead of arithmetic. If this helped you see the tape a little differently, here is where to go next. Comment the word tape or head to imprint.ltd/free, and I will send you the free order flow cheat sheet along with a free NinjaTrader 8 indicator so you can start reading delta on your own charts. None of this is financial advice, and trading futures carries a substantial risk of loss. These are tools to help you see the market and manage your risk. The trading decisions are always yours. If you want more breakdowns like this one,